All right, guys, this is not your nightly watch list, but I am going to drop that here at 9 p.m. Pacific, so make sure you guys are subscribed for that. But I want to talk about the yield curve. And why? Because the yield curve keeps inverting. If you guys have been watching the aftermarket updates, that keeps coming up. We've been, seeing the bond rates. This is the yield curve right here. The bond rates, the treasury. I've been talking about this stuff, and even I made a video on this, explaining it in depth if you guys are confused about what's going on with the curve and all that. But I want to talk about what it means in the short term. The last time it happened was here December 4th, and we're right here, 2 days prior, 3 days ago. That's the last time, and we're seeing it further happen. And people are saying, oh, the market's going to crash. Is the stock market going to crash in 2019 because of it? I want to talk about the short-term effects and the long-term effects. So that's what we're going to get into. Thumbs up the video if you guys are down with it. And lastly, but not least, I better see you on stream tomorrow morning, youtube.com/the stock market. It is in the description. It's pinned below, but we are trading live Monday through Friday. We're live 30 minutes before open. So it's going to be a fun Thursday and Friday. So we're going to see what's happening here. But let's get to the yield curve and let's talk about what the main issue is. It starts here with the yield curve, and now it's not the yield curve that's the issue, but the inversion of the curve where the shorter term rates become higher than the longer term rates. That's the first issue, but now what's going on in the market and now interpreting this on both the short term and long term scale is the issue of what the yield curve inversion says about a recession. It's been this predictor of the recession and whatnot. However, just because the predictor flashes now, this is again the issue right here, right now, and this is what I want to talk about is, what direction will the market go even based upon what the yield curve is talking about in the shorter term duration. But the other issue again is that the bond market is making moves and it's having an effect. And now I guess to explain it, I have a video on bond pricing, but I'm gonna try to keep this simple. But bonds predict the recession in the sense that if investors think or they're predicting a recession or they believe that the Fed is going to cut interest rates, then they are going to actually start buying bonds because they're pretty much thinking that's going to be the highest rates of the cycle, essentially. So they're going to start buying bonds and investors start rushing into those longer term bonds, and that demand drives the rates down actually. So when more people buy bonds, the yields go lower. So when bonds have higher yields, that means there's less demand. And you could think about that in the sense, if a bond is kind of like a loan. If you're trying to attract money, the higher the interest rate, it's going to try to attract investors. So if there's already a lot of demand, they're not trying to attract too many investors. But again, so that's been the issue right now with the market, and when they see an inverted yield curve is that you're seeing investors pile in and start buying those longer term bonds because they feel like if the Fed is gonna start cutting here in a certain time frame, then those rates are gonna start dropping. All the rates are gonna start dropping in anticipation of that, and then prior to the Fed doing that. So that's been the issue now, and that's the one of the underlying issues of how people have been reading the yield curve right now and what they're saying. But now, does that mean the stock market's going to crash or go down in 2019 or even here shortly? There's a divergence between the bonds and the S&P, and I talked about that in the other videos. If you look at a yearly chart of the bonds, the bond rates have just been plummeting downward, and that makes sense. Again, this is a chart. You could see what's going on here. Actually, it's kind of looks reversed, but you'd be surprised, in this cycle. But the bond rates are coming down in comparison with the SPY. There's that divergence, but one of them is going to catch up. Right? Realistically, where the market is right now, if the inversion further continues, it could spark a market correction, not necessarily a crash, because the only way, based on my last interpretation of it, it is going to, I'm going to wait till the Fed cuts. That is going to actually, I think, spark not necessarily a crash, but, really a decline in asset values is what you could call it. But again, though, the thing to notice right here, though, and this is really the main point, that is the longer term scale. And that's what the bond market's pricing out for 6 months, all the way out to even 2 years from now. But there is, some bonds are even raising, again, if they continue at this pace, and this is what I highlighted, here's the 10-year at March 1st, and here's the 10-year today. It was at 2.76 at March 1st, and now today, almost a month, 30 days later, 27 days later, it's at 2.39. So if the 30-year does the same thing, and the 30-year is now at 2.8, but we see the rates drop further and further, that's going to signal, a bigger response or a quicker response by the Fed. However, until there's a big rate cut, the market, could still go up. And that's the next thing I want to highlight here, is that at many times in the market, it was pretty brief in the, 2001. There was a little bit of a period after the curve inverted that the market stayed up, but then it proceeded to go down. However, in '06, and this is where a lot of people, '06, it stayed inverted for a while, or it stayed flat and inverted before actually the market came down and the Fed corrected. But, one thing you guys could do is, you could search yield. I can't even spell it. Yield curve inversion, and do tools on Google. And here, put a custom range, pick a random date here, but then set this to 2007. And you could take a gander at what comes up. I've done this. You guys see, I've done this already. You could see what other investors were saying at the time when this happened. A lot of people, again, I think one of the links said it's the invert. It's like the where is it? It's the crystal ball, or someone said it's the economic boogeyman. So a lot of people, again, interpreting the yield curve and what it does is very unique and interesting. So that's why, too, it's like in the short term, can the markets go down again like it did last time, and can it spark, a correction? Yes, if investors panic. If the bond market, but that's the next level, is that bond markets, even the stock markets, it could overreact and underreact. So if the bond markets continue to, go lower and lower, and then investors do panic, and that causes the S&P to come down and start to converge with the bond rates rather than the bond rates, getting bought back up and bouncing up, then that's where, it starts to get worrisome. But as far as, there immediately being an inversion of the curve, and the stock market crashes right away, or that you see the economy slow down, it doesn't necessarily operate like that. So 2019, it has the potential, I think, at this rate, the bonds are pricing in, it's like a 60% rate or something like that. But if the bond rates do start going lower on the longer term end, that's going to start signaling something else, and that could change it. And, so again, watching the Fed, what the Fed says, economic data, we're going to get that tomorrow, all that stuff, that's going to be interesting. So, putting that all together, that should give you guys some clarity on the yield curve and what to expect here. Is the market going to go down? Again, it's watching investors' reaction and how underreactions, overreactions, but it is going to take time. Any of the big moves right now with the yield curve, it's like playing chess for all those chess players out there. You got them in check, but it doesn't mean you have checkmate yet. It's a move away. However, at the same time now, again, like '06, especially, you could see the markets really, really go up from here. And, it's a different type of cycle, because the last time it got triggered, the last time the curve inverted from here was 2000 to 2005. That was a 5-year period. It's a lot different than, I guess we haven't seen, I guess if you're counting since 2005, it's about, what? That's a long time. That's 14 years, 15 years. 14 years. That's a pretty long time. So that's since the curve last did this. So it's a bigger duration during the cycle. It could act very unique. So I'm watching, investor sentiment and seeing how, if investors react, and there is that, if they think that the S&P is underreacting and the bond market's okay, and the markets start chasing bonds, that'll be one scenario. However, we have earnings coming up. There's going to be trailing data. We just saw Lulu report. I'm sure we might even see some good earnings that could delay the fall before, if anything does arise. And again, how a recession plays out will be very interesting this time around to see. So I'll leave it at that. Hopefully it gives you clarity. Show me some love. Give me that thumbs up, subscribe, watch for the watch list tonight, and I'll see you on stream tomorrow morning. Let's go.